Hey guys, how's it going? Outside smoking a brisket right now. So not in the office, but decided to take a look at some of the stuff I saw in the stock market going on recently. Some things I see mainly on Twitter, on FinTwit, that I think, could be of use to some people and stocks information to consider going forward. So in my opinion, the clearest bid for the next decade is energy, AI, chips, data centers, robotics, electric vehicles, self-driving cars. None of them are going to work without power. They all add electricity, a lot of it. It's kind of almost like the theory I'm sure all of you have probably heard, selling shovels during the gold rush. Energy's kind of the shovel in this scenario, and I saw this one. I believe I pulled this one from Twitter. I should really be giving credit to these people. Well, next time I didn't this time. Didn't think of it. But anyway, this is the total electricity demand over the last 30 years or so, and you can see the box highlighted in red right here. It's the demand consumption from about 2002 to 2022, and you can see that we've been consuming about on average in that same bandwidth there of electricity, which is really interesting to see. I'm not much of a technical analysis guy and know the basics, but you can garnish from this here that rise and breakout here from a sustained level of 20 years shows that these companies really are starting to take AI seriously, and a lot of electricity demand as a result from EV chips, robotics, data centers, all are going to be coming into play. And here's just another graphic. I thought that was pretty useful relating to the, demand for electricity. This graph specifically goes over the demand from data centers, and that it's expected to more than double from current levels, which is pretty absurd, considering the shift that we just saw away from 2023 and 2024, and how you'll see soon enough down on the slideshow what all of the bigger companies are saying and doing related to capital expenditures related to AI. I actually thought this slide was a little down the road, but here it actually is. Anyway, so going through, you can see this is a table of big tech capex, essentially Google, Meta, Amazon, Microsoft, and how much they've spent going back to 2014 on a quarterly basis, and each color represents a shade of the color of the company of one of the corresponding tech companies, and you can see over time and even in the recent most quarter we have data for, you can see these numbers right here, 60, 50, 60, 100 billion as of Q2 2025. I mean, these are exceptionally large investments in AI that, when I see it, it makes me think, well, what do I know? I'm just some regular guy. But when I start to see companies putting big bets on this, that's when I start to take a look and combine with the last couple of slides explaining the electricity demand. I think that's a really good field to be investing in that could outperform the S&P 500 index over the next 5 to 10 years. So I'm sure many of you know File 13F, I believe it's called. It's the disclosures to new purchases made for hedge funds, basically, in short. And a lot of them have come out. I think final reporting's done, and by the time this video comes out, it'll probably be done, if not that week. And I just thought it was interesting. Someone formed this picture together. There are some websites you can use, like Wow Wisdom, Quiver Quantitative. They're both free platforms that have helped me a lot, tracking these filings. I really like Wow Wisdom. Too, you can go into their research tab, and you can kind of scroll through, and I think that's probably where the screenshot is coming. I mean, I got it from Twitter, but I believe they have this top 10 buys and top 10. They have another one that actually says top 10 sales too. Then you can look at it on a dollar basis, percentage basis, nominal quantity basis. A lot of cool ways to look at it anyway. Um, so there's 10 of the largest buys last quarter, which I thought was interesting. United Healthcare, which I'll show some slides later, one of the largest providers of health insurance worldwide, and it's pretty interesting too, well, healthcare in general. But I use them for health insurance, and it's funny because I live in like a small remote area, kind of, and they're the only name in town, so it's funny. Anyway, going down the list, Taiwan Semiconductor Company, Alphabet, Meta, Thermo Fisher, Texas Instrument, Applied Materials, Icon, Adobe, Comcast, all very interesting plays. A lot of the time, I don't have a problem admitting it. I like watching where the big money moves, It definitely, especially when you're starting out, I think it helps you kind of understand and see, like maybe for instance, you see United Healthcare and you're on the fence about it. This could maybe give you this in conjecture with the insider buying, maybe could give you that conviction that turns your perspective from, I don't know if I should buy to let me buy and hold. There are some other here in the top 10 that'll come later into play with another metric I saw floating around on Twitter, and interestingly enough, a couple of these showed up. So we'll also look at that later in the slideshow. Here's a cool slide from Tom Nash. I always want to say Steve Nash, like the basketball player, but Tom Nash. He's a really good guy on YouTube, X. I follow him. He has a lot of really solid stock updates and analyses. I really enjoy his work. Anyway, he posted this. I'm not sure if he's the original creator, but this rule of 40 frontier, and basically it looks at profit margins plus growth rate in one specific quarter. And he ran a scan, it looks like, on several companies and organized them. And I just thought it was interesting. One, I mean, everyone sees Palantir up here, 94%. I mean, it's unbelievable. And but some other notable companies I thought were interesting to see in here were FICO, ZETA, and Adobe, which we'll be talking about later throughout these next couple of slides. First one on the list was FICO. Buying FICO, if it were to fall down to 1100, would be the equivalent of buying it to a forward earnings of 32 times. Not super cheap, but considering the rule of 40 in the last slideshow combined with this recent 31% dip, there's this decoupling from the fundamentals to the stock performance. And if you look at it, it was trading at 82 times earnings only 6 months ago. Woohoo, that brisket gone, boy. So anyway, um, go back. Adobe is trading at its lowest valuation across several multiples, in more than a decade. Price to earnings, price to sales, enterprise value to earnings before interest and tax. Very interesting. And I know, Figma balls, Figma here, has been upsetting and disrupting the industry, but through my personal experiences and workplace, I mean, I think everyone would stick with Adobe given its integration with so many other platforms and easiness with everyone knowing. I mean, a lot of people still making the decisions at the top are old people, and Adobe to them is like still groundbreaking. So I mean, Figma, good luck. But I mean, that's just my opinion. I mean, I like Figma, I like the platform and everything. I'm just saying, from a switching platform and practical use, and at least in my experience, I think Adobe still has strong recurring revenues. Zeta is a AI marketing platform for companies, business to business. Uh, and look at some of their fast financial performances, man, have been very impressive. I mean, they don't stop compounding their fundamentals. Here are some of the points. Revenue's grown 35% year over year. Free cash flows grew by 69% year over year. Net loss margin has improved by almost 8% year over year, but the stock price is down 31%. I got these slides from Twitter too. It was pretty interesting. I think it came from their most recent quarterly earnings report. You can see Zeta's revenue over time steadily increasing along with their customer clients over time. And then their revenue growth by client over time accelerating, which are all key performance indicators of the business. I wanted to show a video of Zeta's most recent quarter's lead report and earnings and discussion from their CEO, but I'm still getting used to, bear with me, I'm still getting used to how everything on YouTube works and how to show it with the slide. But one other cool fact I thought was along with Zeta, it's still founder led. And I saw this infographic a while ago and just was able to pull it up in the Google image search. But there's, I believe, a Harvard Business Review study on this that shows, founder-led companies over time have outperformed non-founder-led companies, which I think is really interesting. And here's just two other graphics I thought were interesting. Everyone I'm sure is well aware of United Healthcare is priced by now down in the gutters, but here's another one, the top six companies by projected 2025 revenue. And you can see Amazon, Walmart, United Healthcare, Apple, Merck, Google, no, not Merck, sorry, McKesson. But very interesting to see. Thought this was interesting too because if you notice, Amazon's been lagging the Mag 7 recently, but if you kind of consider the recent insider selling compared to a lot of other, companies don't really have the Mag 7 here in particular, but definitely Jeff Bezos in particular has been liquidating sizable positions, which I think people should consider as impact on stock price. Same chart, different slide. This time, Amazon sliding in for United Healthcare, which is I just, again to show that I think it's, every dip I see, I've been buying Amazon recently. So basically, I pulled some slides from Twitter and some pictures from the Q1 reportings, and basically, I finally got one here. There we go. Shout out Daniel. You can see his tag right here. Follow him on X, another Lemonade believer. But basically, just some quick metrics. I mean, you guys can go through them on your own time, or I just encourage you to read the quarterly earnings report. But I mean, top key performance indicators like the in-force premium, the premium per customer, and total customers have all been trending upwards with their loss ratio trending downwards. Here are some more slides and some written out points about Lemonade, not to harp on it or anything, but they've just had some very impressive 7 consecutive quarters of top line growth, 7 consecutive quarters of loss ratio improvements, no fixed cost growth, and they're scaling across multiple industries, multiple verticals very quickly. Loss ratio, which is another key factor to look at for them. I touched on the last slide. You can see both the graphics have been trending downwards over. Mercado Libre. This one I thought was pretty cool. Similar start off to Amazon, and I'm sure many of you have seen this name going around, ticker Melly. But it's pretty funny because everyone's like, I don't want to own the Spanish Amazon or whatever. I'd rather just own Amazon. And I was guilty of the same naive thinking. And once you start to look under the hood and see what's going on, they have vast operations through many verticals, which are very impressive. And you kind of just look at these two charts and see, their cash flow from operations here in blue continually has improved while their stock price or market cap, I believe is reflected here, has stayed flat over time. Here are just a few other metrics I wrote down for Melly. Revenue and income up 37%, operating income up 45% to 763 million, net income up 44% to 494 million. Free cash flow is still slightly negative at 10 million, a lot of it due to heavy investments, but then again, they do need investments to grow, but once they get to scale, hopefully they can scale back on these investments and turn, more of that financing and investing cash flows to free cash operating flows. Next, we have ad revenue up 50%, and this is where I'm trying to touch on those different verticals where it's really they have their hand in a lot of businesses here with their digital wallet reaching 64 million monthly active users, up 31%. Their credit book is up to 7.8 billion, a 75% increase. Just strong growth across several verticals.